Hello and welcome. In this presentation, we will be diving into a powerful managerial tool known as Activity-Based Costing, or ABC. We'll discover how this method provides a much sharper, more accurate view of true costs, moving beyond simple volume-based allocation to understand what really drives profitability in an organization. Here is the path we'll take today. We will start by uncovering the limitations of the traditional costing systems that we've discussed previously. Then, we will introduce activity-based costing as a more robust solution for internal management. We'll visualize the flow of costs in this new framework and then deconstruct costs using the 5 levels of activity, which is a core concept of ABC. We will cover the nuts and bolts of the system, understanding terms like cost pools and drivers. And finally, we'll discuss what costs ABC strategically excludes and why this leads to better, more informed management decisions. So, let's begin by understanding the problem that activity-based costing was designed to solve. Traditional absorption costing, while necessary for external reporting, has 3 significant limitations when used for internal management decisions. First, it ignores non-manufacturing costs. It only assigns manufacturing costs to products, overlooking crucial expenses from selling, distribution, and service that are obviously necessary to generate a profit. Second, it relies heavily on volume. It uses a very limited number of overhead cost pools and typically allocates them using volume-based measures like direct labor hours. Finally, this reliance on volume distorts product costs. It often allocates too much overhead costs to simple, high-volume products and not enough to complex, low-volume products. The result of all this is that managers may be making critical decisions based on flawed and misleading cost data. Activity-based costing was designed specifically to overcome these limits. It provides a much more accurate picture of product profitability for internal decision-making in 3 fundamental ways. First, ABC includes relevant non-manufacturing costs in product cost calculations, but only on a strict cause and effect basis. Second, it strategically excludes some manufacturing costs from product costs if they are not caused by the products themselves, such as the cost of unused factory capacity. And third, it uses numerous overhead cost pools. Each of these pools is allocated to products using its own unique measure of activity, which allows for much more nuanced and accurate cost assignment. To understand ABC, we have to visualize how it redefines the very concept of overhead. This flowchart illustrates how ABC expands the definition of costs that should be assigned to products. Notice 2 key things. First, ABC creates an expanded overhead category that includes indirect costs from both manufacturing and non-manufacturing functions. Second, it also traces direct non-manufacturing costs, like a sales commission, directly to products. Under traditional systems, these would simply be treated as period expenses. The guiding principle of ABC is that any cost that is truly caused by a product should be assigned to that product. A core concept that separates ABC from traditional systems is its cost hierarchy. While traditional systems really only recognize one level of activity, production volume, ABC defines 5 distinct levels, many of which do not relate to the number of units produced. At the bottom, we have unit-level activities, which are performed for each individual unit, like providing power to run processing equipment. Next are batch-level activities, which are performed for each batch regardless of the number of units, such as setting up equipment for a production run. Then we have product-level activities, which are performed for a specific product line, like designing or advertising that product. Next are customer-level activities, performed for specific customers such as sales calls or technical support. And finally, at the top, we have organization-sustaining activities, which are performed regardless of any products, customers, or units, like heating the factory or preparing the company's annual report. To work with ABC, we need to understand its language. It relies on a few key definitions to connect overhead costs to the activities that cause them. An activity is any event that causes the consumption of overhead resources. An activity cost pool is essentially a bucket where we accumulate all the costs that relate to a single activity. And an activity measure is the allocation base that we use in the system. We also call this a cost driver because it should be the factor that truly drives the cost being allocated. There are two common types of these activity measures. Transaction drivers are simple counts of how many times an activity occurs, like the number of bills sent to customers. Duration drivers measure the amount of time required to perform an activity, such as the time spent preparing those individual bills. Just as important as what ABC includes is what it strategically excludes from product costs. A key feature of ABC is that it purposefully does not assign all manufacturing costs to products. First, it excludes organization-sustaining costs. These are costs like the plant controller's salary or the factory security guard's wages. ABC treats these as period expenses because they are completely unaffected by which products are made during a given period. Second, ABC excludes the cost of unused capacity. Traditional absorption costing allocates all manufacturing overhead to products, including the cost of idle capacity. This can cause unit costs to fluctuate wildly as production falls. In contrast, ABC systems charge products only for the cost of the capacity that they actually use, not for the cost of capacity they don't use. So, let's bring it all together. Why does activity-based costing lead to better management decisions? First, it provides more accurate product costs by using multiple activity pools and cost drivers that go beyond simple production volume. It also provides a broader view of cost by strategically including relevant non-manufacturing costs, like sales commissions or warranty repairs, in its profitability analysis. And finally, it improves accuracy through smarter exclusions by not assigning costs like organization-sustaining activities or unused capacity to products that did not cause them. The result is that managers are equipped with far more reliable and accurate cost data, which leads to better and more profitable strategic decisions about pricing, product mix, and customer relationships.